Hi, everybody. Larry Berman here for another exciting week of Investor's Guide to Thriving. 35 years and one day. What does that mean to people? Well, it's the 35th year of the 1987 stock market crash. And that was very, very early in my career. I was sort of selling mutual funds at the time, but I had several jobs. One of them was working for the Toronto Star, driving a truck around in the middle of the night, throwing off papers. And so I had shares in Torstar and wondered why over a couple of weeks the value of my savings went down 30%. So that was one of the catalysts in my life and my career for, pushing me towards the investment industry. At the time, I was studying to be an accountant at York University, and quickly realized that I didn't want to audit financial statements the rest of my life. Not that that's what an accountant does necessarily, but always had that interest in financial markets. And in 35 years plus that I've seen, we've seen all kinds of trends come and go. We've got a guest on tonight from BMO, as we normally do in our educational segment of the show, to talk about green energy, clean energy, the future of energy. And so that'll be very interesting coming up shortly. First, I want to thank our sponsors and the group of companies that we support and support us. And I would encourage anyone out there to, do a quick Google search, find out what we're all about, and see if we can help you. Special thanks again to Bank of Montreal for being a longtime partner with us, not only in the ETF and the funds we manage for them and with them, but also in our philanthropy. We do these seminars free to everybody. Hopefully people learn a little bit each week about maybe making a better investment decision, or maybe getting an idea of what to invest in the future. And if you do, we thank you very much. And to thank us, you can reach out to one of our charities. So in the email that you get following up to these webinars, there's a link there, and you can make a donation to cancer research at the St. Kitts Hospital, or Dementia and Alzheimer's research at the Baycrest Hospital and Foundation. Vish Bhatia is here tonight, and from BMO, every week, as people will know over the years, we have a different specialist from BMO funds and ETFs come in to talk to us about different ideas, different ways to get market exposure. And tonight, the focus for Vish is capturing the clean energy transition. It's something that I'm quite passionate about. I've talked about uranium for a long time being a green transitionary metal to get us from, high carbon output to what they're calling net zero emissions. But let me turn it over to the expert here, and I'll go off camera, and you can hear from BMO here. So take it away, Vish.
Thank you, Larry. I'd like to talk a little bit today about responsible investing with a focus specifically on clean energy. And, what are we seeing around the world when it comes to clean energy specifically? At the core, there's been really a global revolution moving towards responsible and renewable energy use. And we're seeing it all over the news and media these days, and with various countries around the world setting carbon emission targets and dates. A lot of companies discussing renewable energy use and how they can incorporate or strategize on ways they can integrate scalable renewable energy sources into their operations. We're also seeing greater demand from investors who are seeking to know more about the topic and how they can invest alongside the anticipated growth in the clean and renewable energy space. So what are the fundamental problems that clean energy are trying to address? And I think it's things that we can all appreciate. Given that energy fuels our daily habits, the traditional fossil fuel resources like coal, crude oil, and other fossil fuels that have been around since the industrial age, they come with some problems, some challenges, in that they have a limited supply and have large costs, both explicit and implicit, associated with them in terms of extracting them, harvesting them, as well as ultimately the cost to the environment. And the prevailing science suggests that really the energy sector is the source of roughly 3/4 of the greenhouse gas emissions that really hold the key to the worst effects of climate change. And so in order to figure out how to avert climate disaster, as it were, one is perhaps best advised to focus on that energy sector. And I think we've all read about and witnessed the increased frequency of extreme weather events around the globe in the last few years, and this year's invasion of Ukraine by Russia and the pain at the pumps that we've all been experiencing. Really, it's a great reminder of the importance of energy security as well. So it's quite a timely topic, the topic and the need to move towards lessening our reliance on the fossil fuels of yesterday and moving towards perhaps a more sustainable or renewable sources of energy. Going forward, I think the impetus is quite clear. So what we want to look at really is, how are governments and industry aiming to accomplish that? So Larry, if you can go to the next slide, we can look at how they propose to move to the next level in order to address the climate change issues that we talked about. And really, what's happening here is that the corporations and governments are focusing their efforts on what's called decarbonization, an initiative called net zero, as you mentioned, which is really a phrase to describe the aim of cutting greenhouse gases emissions to nearly or at zero by 2050 or so, and significantly reduce them by 2030 or so, with any remaining emissions to be reabsorbed by the old school way, which is to say by oceans and forests, for instance, the way it would have been done in the pre-industrial era. And so, why are we seeking to, reduce emissions to net zero? Well, I think, many of us will know that the science shows that in order to avert the worst impacts of climate change and preserve livability for all of us, that the global temperature increase needs to be limited to about 1.5 degrees above the pre-industrial levels. Now, as we stand now, the Earth is about 1.1 Celsius degree warmer than it was in the late 1800s, and emissions, have been continuing to rise. So, in order to keep the global warming to no more than 1.5 degrees Celsius, which is what's called for in the Paris Climate Accord, emissions need to be reduced significantly by 45% or so by 2030, and ultimately, hopefully, reach net zero by 2050. So it's no small effort. It's perhaps one of the greatest challenges that we've faced, and it's going to require a complete transformation in the way we produce and consume energy and move around and whatnot. So given, as I mentioned, that the energy sector is thought to be roughly responsible for about 3/4 of greenhouse gas emissions, it really holds the key to averting those worst effects of climate change. And so that's why focusing on clean energy is so important. Now, is there a global effort underway to reach net zero? Yes, indeed. In fact, the graph illustrates that a number of countries there has dramatically increased in terms of those who are making explicit commitments to dramatically reduce carbon footprint. It's gone from back in Jan 2020 of 21 different countries with explicit net zero commitments all the way to 140 countries at November 2021. And similarly, this is happening, in the corporate space as well, with the number of companies making net zero commitments having increased dramatically as well, just around 1,000 or so with explicitly articulated net zero commitments back in 2020, and only just a year after that, 5,230 companies. So that's wonderful news that countries and companies are making explicit commitments to reducing their footprint. But of course, all the commitments in the world won't help unless it's backed by actual action. And so what's being done on that front, given that the commitments on their own will do nothing. And so I guess really, if you look at the top 3 countries in the world in terms of carbon emissions, that's China, US, and then the EU, not a country, but the region. And so they're responsible for about half of the carbon emissions globally. So clearly, what those three regions do in terms of reducing their carbon footprint will have a dramatic effect on the success or failure of the move towards net zero. Want to go to the next slide, Larry, please? Right. So what's happening now in terms of action? If we look at where we stand today, are we getting close to, or are we in the right direction towards moving towards net zero? And not exactly, but the U.S. Inflation Reduction Act is one very positive move that was made relatively recently by the Biden administration, and that's going to be, relatively revolutionary in making a move towards the net zero goal. In that the U.S. is going to be allocating about $370 billion towards clean energy and combating climate change, which represents the biggest investment in climate in U.S. history, and should help the U.S. reach their 2030 goal of cutting the carbon emissions by around 40 to 50%. So certainly having, the second biggest carbon emitter in the world, making this commitment and backed by actual, action via the Inflation Reduction Act, that's a very positive sign that, the big carbon emitters are beginning to take the need to do this, very seriously. And so that should bode, very well for the companies that are ultimately going to be at the forefront of, changing the landscape of clean energy, or the energy landscape, as it were. If you go to the next slide, Larry, please. Right. So, the question becomes, why is this a timely opportunity? And this is not like a tactical opportunity to invest in clean energy. This is like a, a mega trend, a long run trend that we expect to be sustained going, forward for decades to come. And, what this particular graph from BP Energy, British Petroleum, shows, this is from their 2022 outlook for energy. And it's an interesting one that lays out really the shift in global primary energy sources all the way back to 1900, and then their projections for the share of these sources out to 2050. And what you can see here is that, if you look at the top there, the share of coal as a proportion of primary energy sources from 1900 onwards has been on the decline. And you see really a tipping point being reached around, right around now, 2019 to 2020, thereabouts, whereby you see renewables in yellow making a dramatic shift upward in the proportion of the global energy landscape. And so this is by BP's own account, who obviously has vested interest in oil and gas, and they themselves can see that this renewables share of the global energy picture is set to dramatically increase, while there's in oil and gas is set to decline as a proportion of the overall picture. So that's a clear tipping point for renewable energy and accordingly clean energy stocks. So this should illustrate that it's a long-term generational trend, and it's backed by the net zero coalition and the need for governments to set these aggressive emission targets and so on, and backed by action as well, besides just the commitment. So the clean energy companies are those that stand to benefit. So what's driving the tipping point towards the rise of renewables as a viable alternative to fossil fuels? This next slide shows essentially that cost efficiencies are what lie, as one of the key drivers for the dramatic, change in the proportion of the energy picture that renewables represent. And so you can see that, historically, going back not too long ago, back even to 2010, the costs per megawatt hour of electricity for solar energy, for example, was in and around $350 per megawatt hour, and wind similarly was more than double the cost of coal and natural gas. And what you've seen now is a dramatic shift again in the cost efficiency of these alternatives. So that's a total game changer. Fossil fuels used to be less expensive than cleaner energy, but this is changing, and with renewables set to become more affordable each year, some options even being cheaper than fossil fuels. The price of solar has declined by 90% since 2010. So that's quite notable. It's now cheaper to go solar than to build a new coal power plant in most countries. So that is certainly something that is in favor of renewable energy. And so what's driving this reduction in the cost of delivering solar energy and renewable energy like wind? Really, it's technological innovation, falling costs for technology, improvements in battery storage technology, for example, and many other innovations. So that really bodes well for the renewable energy sector, which is expected to see record investment from public and private sources and capture a larger share of the energy mix. And of course, a clean energy ETF is an easy way to leverage the shift out of fossil fuels and into new energy sources. I'd like to go to the next slide, please. So, basically, if you look at the cost competitiveness of renewables coupled with this global shift, the policy shift towards renewables in order to avert climate disaster, we can see that the composition of the energy landscape is set to change, quite notably going forward. And this illustration is from the International Energy Agency and the World Energy Council. And what it shows is that global electricity demand by fuel type used to generate that electricity. And there's a couple of things that you can take away from this picture. One is that global electricity demand is increasing. If you look back to 1990, 1990 or so, around 10 million gigawatt hours. That was sort of the global electricity demand back in 1990. And it's expected to go all the way up to roughly about 50 million gigawatt hours by 2050. And where we stand right now, right around 25 million gigawatt hours. So, we're going to need more electricity. That's one thing to take away from it. But more importantly, the key takeaway here from this picture that I take is that the proportion of electricity generated by renewable sources of energy, particularly wind and solar, while representing only 9% of electricity demand today, it's expected to account for 50% by 2050. So that would represent a very sustained shift in the landscape. Is one that investors should consider adjusting their sails to capture. That's which way the wind is blowing. We can go to the next slide, please. Now, the other key driver underlying the investment case for investing in renewables is that, I guess, firstly, in order to reach the target of net zero emissions as laid out by the UN Net Zero Coalition, it's been estimated that renewable energy generation capacity has to increase about tenfold. So, the companies in this space and those that will enter the space, they should experience very significant growth on the back of the need to dramatically increase capacity. And number two is, as you previously saw, the increasing global electricity demand, which is driven by numerous factors, but things like growth in demand in the developing world as demographic changes take place, it's expected to act as another driver for growth in this space, as renewables are going to be taking a bigger share of the pie than they did in the past. So, I would say that although this year, while investors have been largely and rightly, focused on other worries from rampant inflation to the Russian invasion of Ukraine and, crying into their porridge over volatile markets and poor returns, we just wanted to remind everyone of some of the long-term opportunities out there that investors can capitalize on. It's not a tactical short-term investment opportunity. It's a mega trend. It's a generational shift in the makeup of how the world is going to be powered, and we expect this to be a sustained growth area for a long time to come for investors that are accordingly investing for the long run. And the last slide, or second last slide there, Larry, thank you. So one way to put this thought into action and invest is via the Z-Clean Clean Energy Index ETF. And this is a way to essentially capture this growth opportunity and get exposure to a variety of types of companies, all of which we expect should participate in this growth opportunity. Broadly speaking, it's divided into two sort of categories: clean energy producers and clean energy technology and equipment, both categories being, of course, key. And clean energy producers, although thus far I've talked about wind and solar, it's in fact broader than that. It encompasses biofuels and hydro and other fuels like ethanol and so on. So those type of opportunities are captured in the fund, as well as the technology underlying the generation of all of this electricity. And so via this fund, you get concentrated exposure via 100 of the top global clean energy stocks that are weighted with a maximum weight in place, along with a weight partially being determined by their exposure to the clean energy theme. And so it's screened for liquidity to ensure that it's highly tradable. It's screened to make sure that companies are of a minimum size, and it's reconstituted semi-annually just to ensure that the portfolio represents the best-in-class companies in this space. And so via one vehicle, it's possible to get exposure to the entire space, which is set to evolve over time, and the fund will evolve with the evolving space accordingly. The last slide just shows very long run, and this is not the history of the fund, but this is history of the index that the fund tracks. And you can see that, historically speaking, going back, way before the fund was launched, the performance of the clean energy space, as represented by the S&P Global Clean Energy Index, as compared to just the market cap S&P Global 1200 energy sector, so that includes, all energy stocks, they performed, sort of relatively, in line, more or less. At least they moved similarly. But you can see a big change happening right around 2020 when you see the clean energy space really take off. And I guess that really testament to companies and countries and the UN and so on. I guess realizing the gravity of the situation and the need to shift energy sources, along with the tipping point having been reached in electricity and alternative sources of energy becoming more economical to generate, more cost efficiency and so on, coupled with technological changes and so on. And so that's sort of where you see things really take off. And we expect that that the clean energy space is one that will continue to flourish for those long-term investors who wish to be exposed to the space. As well, as part of our renewables space, we also offer another exposure via our partnership with BMO, with Brookfield, via the BMO Brookfield Global Renewables Infrastructure Fund. The symbol is GREENI, GRNI, and that's another way to get exposure to this this theme via infrastructure, which itself is another very topical theme, particularly in this time as we all seek to fight inflation.
So great, and to remind everybody that great education like this and others is available weekly with BMO on their YouTube channel, and you can subscribe to that. ETFmarketinsights.com is another great resource that BMO has. You can use the QR code there to bring up some of those things. And Vish, thanks a lot for your information tonight. It's clearly, when I think about the growth fund that I run, we have a clean energy sleeve, and every dip we get, I'm focused on buying it, because when you think about growth and you think about where that's going to come from, maybe the next couple of years there's still trade in traditional energy, but in the long run, there's certainly more growth in other areas, and we've already seen that for the most part for the past decade. So thank you very much for being here tonight, and again, thanks to BMO for being just a great partner and sponsor over the years.
Thank you.
Okay, so moving on now. So my YouTube channel, if you haven't subscribed yet, please do. This is something that, as a repository for, all kinds of information, there isn't a week that goes by that I don't watch more than a handful of YouTube videos, whether that's a golf swinging thing or it's a clip from a TV show that I missed last week. It's really an incredible platform. And so, at Larry Berman Official is our YouTube channel. So please follow along. Okay, Investor's Guide to Thriving, Larry Berman edition. So, when we talk about clean energy and themes and trades, the biggest question we always get is around volatility. And so tonight I would, on the 35th anniversary, I thought I would talk about, volatility and market bottoms. And so that I'll focus a little bit on that. And what I want to identify is a market bottom versus the market bottom. And a market bottom is generally, okay, what's going to happen in the very, very short run, weeks, months, quarters kind of thing. So a tradable rally. versus the market bottom, which identifies a period of time that is effectively, the beginning of a new cycle. And what we're in now very clearly, and I'll get into the meat of this in a little bit, but we're very much on the inflection point that the next few decades could be very, 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 very different than the last few. And the big reason here is inflation. It's less globalization. It's clearly geopolitics, the way the world is moving. So I want to share with you a couple of thoughts there, and of course get into our weekly Q&A period. So a market bottom, a tradable rally, we use our set of indicators in the Pro Eyes series. Again, Google, Berman's called Pro Eyes. It's there every week. We update it. And what we're looking here at is a statistical measurement of each of the 20 factors and how they're valued or related in a statistical way. So a Z-score is a measure of standard deviation above or below the mean. So for example, when you look at equity risk premium and you see that at 1.1, that means historically the equity risk premium, as we've defined it for the S&P 500, is 1.1 standard deviations above normal, and that translates into a higher risk level of around 86%. When you look at the forward PE, you see us at minus 0.8 standard deviations, and that equates to a risk level of 21%. So the four ways we measure market valuation averages out to be about neutral. Markets are no longer extremely overvalued like they were a year ago, but the equity risk premium is a little bit high at the moment. One of the reasons for that is what's happening in the fixed income world because of the risk-free rate. Again, I'll get into that a little bit more when we talk about that, but and I know we have a question on that tonight, so I'll dig into that a little bit more later on. When we talk about the liquidity and the business cycle, credit expansion is a big part of that. So what's happening in the high yield market or the lower credit rating companies versus the higher credit rating companies and those spreads, and that defines a lot about the risks that are in the market. There's the real interest rate level and real inflation expectations. There's what's happening in the broad economy by way of weekly indicators, leading indicators, and then there's the liquidity in the financial markets for banks and lending, and that's the slope of the yield curve. And all of those are basically on very high risk and cautionary cycles. So we know based on this that we're very, 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 very close to the end of the business cycle. And that has a lot of implications when it comes to thinking about a market bottom versus the market bottom. Our tactical or technical factors based on trend, momentum, and sentiment, etc., market breadth, are right now extremely oversold. So on a tactical basis, we've got a bottom potential. On a business cycle basis, we have yet to peak and only have downside, from where we are here. One of the differences this time is the ability for the Fed to ease and for central banks to, for governments to spend and for central banks to cut rates. What we just went through is a colossal example in the history books of what not to do when we look at what's happened in the UK. We had a new government put in, they announced a policy right away. It was going to cost them billions and billions of dollars in unfunded obligations. They didn't have the money. At the same time, they were trying to unwind their balance sheet, and bond yields just spiked. That caused a knock-on effect in some leverage that was employed in the insurance industry, and that just made a whole mess of it to the point where the central bank had to step in and said, we're going to buy all the bonds. And so we've got this incredibly big footprint that the government needs to every once in a while step in. Japan's a massive example of this. So when I talk about the forecast a little later on and what some of these long-term forecasters are prognosticating, I'll elaborate a little bit more on, the big government footprint that we're going to be having to live with, and in part how inflationary that could be. But from a tactical perspective, right now, compared to any other low in the last decade, and you can go back and, well, you can't go back and look at it because we only post the last decade, but I've got the data going back decades. This is about as attractive as it gets when all the technical indicators now, including seasonality, line up for a good tradable rally here. So, I think we're in the buy dips mode, but make no mistake, the rallies are likely to fail. And our Pro Eyes series really underscores that. Right now, the markets aren't hugely overvalued and they're not overly cheap at the moment. Some of the downside targets that you hear from various forecasts, 2,200, retested the COVID lows, 2,700, 3,200 in the S&P, so we're sitting at 3,700 today. So at 3,700, you got 10% downside, 20% downside, 35% downside still, depending on, what does the Fed do here? Are they able to generate a soft landing or not? And that's going to be the next year or so, folks. And right now, it just doesn't look pretty. So, we're playing for a bounce here, but not a lot more than that. When it comes to understanding better what the market bottom is all about, you have to understand the business cycle or a bubble that gets created. Now, I didn't write any of this. This was taken from a book that was published about 15 years ago by a guy named James Montier in behavioral economics. Montier is a strategist for Grantham, the GMO group out of Europe. I've spoken to him a number of times on this topic over the years. And identifying where we are in the expansion and contraction part of the business cycle, we have not seen financial distress. COVID, listen, the world shut down. 2018, we had a volatility spike. We had the Fed starting to tighten. There were no recessions there. I'm talking about recession. So the last, yes, we did have a recession in COVID, but again, the world shut down through an exogenous event that no one on the planet could possibly have predicted or really seen coming and to do anything about it in any major way. I'm talking about the expansion of credit, a bubble. Jeremy Grantham believes this is probably one of the biggest bubbles ever, and I think his downside targets are more in the 2,200 area, and that we deflate the entire, post-COVID rally. And so maybe not, but identifying, where we are in the cycle of a bubble is important. I want to focus on the where we just came from, euphoria, and then the critical stage or the financial distress. The revulsion is the phase where, listen, don't talk to me about equities. I don't want your best idea. I'm not going to watch Berman's call anymore. I'm just so disgusted. I'm putting my money in cash. So we'll identify that phase. We didn't get that with COVID because of what the central banks did to print money, to support the financial markets. We didn't get that in 2018 because the Fed was able to pivot. And the challenge this time, of course, is what happened in the UK. Budgets are stressed. The central bank balance sheet is stressed, although they can keep printing money forever. But right now, that combination of governments creating debt, central banks monetizing the debt, getting everybody liquid again has created this pretty big credit bubble. The credit side of that is imploding already, where we see credit spreads blowing out, although not to historic default levels that we would have seen, for example, during the great financial crisis, and so forth. We're not even close to the market puking yet, to the revulsion, to the I can't stand it anymore, get me out. And the question is, do we get there? And the hope is we don't, but hope is not an investment strategy. I'm not forecasting that at all, by the way. I'm just trying to identify what these kind of phases look like so that, you know, whenever the next time is we go through it, you know, you can recognize it yourself. Obviously, down the road, 10 years from now, whenever it is, if I'm still on BNN, then you can tune in. But, you know, I've 16 years already, and I can't imagine 10 years from now I'm still going to be doing it. But who knows? Still very popular, and thank you all for watching. So again, clipping definitions out of Montier's book, and the definition and part of what we look at in euphoria phase. You know, the great economist Adam Smith referred to this period as overtrading. And to me, the poster child of that were SPACs, that many of them are imploding, meme stocks, Robin Hood, guys calling stocks stonks, just the whole utter stupidity of what happened. and you know, again, you can criticize me if you like in that way, but you know, I'm an investor with a fiduciary obligation, not a gambler, speculator, or day trader. So, you know, all this stuff to me is a poster child of what the definition of euphoria is. And it's always and only with the benefit of hindsight that you can recognize that peak. And now as we look at the last few years of the S&P 500, you go, what was I doing buying GameStop at $200? Well, it was a gamma trade. It was options related. It had nothing to do with anything related to common sense whatsoever, and had everything to do with buy it, make a couple bucks, scalp it, trade it, red it, blue it, white it, like whatever. You know, it was just a period. And now you see a stock like AMC, which at the end of the day, folks, it's a friggin' movie theater chain that is now trading at about, I don't know, $6 or so. And okay, right? But at 12 and at 20 and at 30, like, are you friggin' kidding me? Anyways, again, so we've passed that euphoria stage. It's been identified by this, you know, just everybody coming out with a product to sell you something that was moving. And listen, that's what Wall Street does. That's what Bay Street does. You know, I don't want any part of it, frankly, but that's kind of what it is. And so hopefully, you know, you know, when Kathy Wood's ARC, I love their research. I love how they dig into a company, they understand it, they understand the innovation and the disruption. But there's a big difference between a good company and a good stock. And a good stock has value and intrinsic value and is not in a speculative state. And when you're in a speculative state, you've got to think like a trader or speculator, not an investor. And so you get this time frame mismatch, right? Where, you know, but that's a characteristic of a bubble state. And when you're in it, you can't call a top. Nobody wants to believe it. Tops are the hardest thing to call. Spotting a bottom, spotting the bottom are far easier because you have also a lot of hallmarks that you can look at in terms of revulsion and desperate state and so forth. This is the worst year ever, pretty much, for a 60-40 conservative balanced investor. And certainly in decades. There's other examples over history where you've had bad years for risk parity type strategies. And we recognized at Q Wealth and ETF Capital Management years ago that you needed to do different things to protect people in portfolios. This is why last year, when the markets were at their peak, and earlier this year, we were trying to educate people about option strategies and how to use these innovative ways of using options to protect your portfolio. And we're having a very, very good year in most of our portfolios. So right now we're in this critical stage. And the critical stage here is where we get financial stress. Obviously in the dot-com bubble, we saw a significant stress. This chart that we're looking at here is basically your 5-year yield. And so we have not seen these kind of yields, short-term interest rate, medium-term interest rate. This is the mortgage market, right? And, so the last time yields got to this level, the housing sector collapsed. And I'm not saying that's going to happen this time at all. But, the affordability of housing is just stressed. So you have most people's core asset that is in a position that, with the delayed impact of monetary policy tightening, and that is it tightens, but you're on a fixed mortgage and you don't realize it for another 2 years. And so 2 years rolls around and your last mortgage was at 2.5%, and now you're refinancing at 5.5 or 6.5, and all of a sudden your payment that was $2,000 a month is now $3,000 a month. And the question is, where is that extra $1,000 going to come from? Now, if you have wealth and savings and excess, it's uncomfortable. You're not happy about it, but you're going to be fine. But there's an element that's stretched a lot for their homes. And there's going to be some duress there. What does that mean in the next few years? I don't know. There's all kinds of people forecasting that stuff, and I'm not an expert by any stretch of the imagination. But what I can probably say with confidence is the next couple of years, the pain of this interest rate increase to fight inflation is going to ripple through the economy painfully and slowly. Whether that takes a year or two, the central banks are telling us higher for longer to fight inflation, right? And, we looked at that in past weeks and the components of inflation, and, they're rolling over a little bit, but we're not there yet. This morning we got initial claims data for unemployment, and this is the week they do the survey for payrolls. And, it was a pretty low number, which means we're going to see another robust month of a pretty good job growth in the US. And that's not going to push the Fed any closer to pausing. And the market really wants them to pause. They want to see the central banks get to that terminal rate as fast as possible, and then just wait and see what happens. And every Fed speaker you hear kind of says we're not there yet, and by the end of the year, we're going to get more aggressive. So a lot of people want to know what, basically what that means for their portfolios. And, the answer is that it could be a little bit stressful still, right? So obviously this stage, we're starting to see some stresses. We're seeing it in some places in the credit market, but where we have not seen it yet, and the traditional recession comes not because inventories are correcting, comes not because there's less building in houses, It comes because people are getting fired and laid off and incomes are going down and the burden on the government for social benefits is going up and so forth. One of the things that's different this time than pretty much every other cycle that we've seen in the past 40 years of globalization is deglobalization. So, when it comes to what the world's going to look like going forward, I love reading too. Actually, I don't read anymore because I fall asleep when I'm reading, but that might just be an age thing. I listen to books, audio books. And so I go for a walk and I get the book in and I'm walking the dog and I'm listening. Before I go to bed, I listen to a book for a half an hour. Anyways, for me, it's being very productive. So I recently got through this Peter Zihan book, Zion, I believe you pronounce it. He's got a great website. Go check him out. You must read this book. Demographics has been something I started talking about a decade ago on Berman's Call and in our, road shows and webinars. China is 1.4 billion rounded up people today. They expect by 2070, based on demographic trends and birth rates that they know today, things could change in the future. China might have 700 to 800 million people by 2070. That means their growth, not unlike what's happened to Japan over the last decade, where they just can't grow. And now it's starting to impact their currency and everything else. And so where the growth is going to come from is in free, open, democratic markets if we don't mess it up. The US that has 600 or 330 million people today, by 2070 could have 660 million. Canada, 35, could have 60, 70 million people. So where's the growth coming in the world? It's coming from emerging markets where birth rates are still high and the average woman is in her 20s compared to the developed world, North America, where the average woman is in her late 30s and just not really having in the kid-bearing age. And through immigration, and so the next real big phase of globalization is going to be, a lot less trade globally and a lot more immigration. And so it's going to be very, very interesting. So I encourage you to understand and read and listen to what Zion thinks about the world. Not that he's going to be right on everything, because he's just not, because no one can be. When you look at what came out this week that got a lot of eyes and ears on Wall Street, was this piece put out by Russell Napier. And he's talking about a couple of decades of inflation and stagflation. And initially we're going to like it because we're going to get this big capex boom. And that has to do with less globalization, more just-in-time inventories that have turned into just-in-case inventories, and more, it's Micron spending, $10 billion building a new plant. It's Intel. It's a lot more local, and that's where the job growth is coming from. You're seeing a lot less reliance on global supply chains, one out of necessity, two out of what has been accelerated by, what's going on, for example, in Russia and Ukraine, and the increasing isolation of China. I saw a headline today where Iran is actually got soldiers on the ground in Crimea helping the Russians kill civilians. I'm just beside myself, when I think about what's happening in the world today and what it's going to mean. But this is all very, very inflationary. So we very much may get into a period where what the Fed would like to happen probably can't. That core inflation falling back to the 2% range. And so this is going to be very interesting. Nobody investing today was investing in the 60s and 70s where we had this persistent inflation. And this is going to be a challenge for investors who think like a traditional portfolio manager in a 60-40, 70-30, 50-50 kind of box. We increasingly have to get creative, have to get our yields in different ways. But something like clean energy, this theme plays incredibly well into the future because it's something that on an increasing basis, I think one of the slides that Vish has was about, listen, people are voting for this. Now, not everybody's voting for it, but on average, the vote is increasingly going towards this. So ESG as a factor in investing is going up, but I think it has an inflationary cost to it. And so there's a lot of things happening, that what Napier says is this, we're going to get this CapEx boom. Now, in 2012, at around 21, US market cyclically adjusted PE, that he said the bear market for the S&P 500 will end around 450. And he was colossally wrong about that call. So there's no reason to believe that he's going to be right about this, him nor anybody else making a market call, or a Berman's call for that matter. But again, when you look at what a thoughtful person thinks about the world and presents a valid logical argument for it, other than here's just an opinion, that you've got to consider that. And I do, and I like to look at what smart people, well thought out forecasts are. And so I believe we're going to go through a couple of decades here. Russia, at least until Putin's out of office, and maybe even a decade or two longer than that, unless there's a dramatic shift and the Cold War goes away. I just don't see that happening. I don't see China under Xi for as long as, forever until he passes, I guess. That China is not going to want to be a reserve currency and do their own things. There was a very material move by the US in policy around semiconductors. I made a trade last week in my portfolio where I reduced my exposure to China and I added exposure to semiconductors. And so here's another theme where a year ago it was in a bubble. It was clear NVIDIA was trading at a level, and I love the company, but it was trading at a level that everybody on the planet would eventually be a Bitcoin trader, right? Like, I'm joking about that. There's no basis to that, but I'm saying it was in a speculative bubble. And now NVIDIA is starting to get interesting. It's still a little bit expensive for me, but it's starting to get interesting versus where it was trading a year ago in a much more speculative world where money was easy. The Fed had not, inflation was transitory, interest rates weren't going to go up. When you look at a company that trades at extremely high PEs, or a company that has a lot of leverage, and because money's cheap, they get by. This is why companies that have better balance sheets are doing far better today than companies that have to rely on credit to grow. And so again, that's part of the bubble I was talking about. So the pain period is coming. As long as those companies can keep financing with debt because they have negative cash flow, they'll be okay. But their stocks are not going to get, a huge valuation to them. And so this is the phase we're in right now, folks. It's painfully obvious. So again, when we think of the world and the future, demographics are going to matter. for all the bad and stupidity about what's the US Social Security system, has no assets in it, but a promise to pay, and all those things that I've railed about and complained about and was concerned about for decades, the rest of the world is way worse in many cases, with a lot of exceptions. And a lot of those exceptions are based on demographic positions and what the demographics of a place like India, where the average woman's in her early 20s and still having a lot of kids, they've got massive growth, where China, the best of it's in the rearview mirror. Like, you can't dispute that, because China's not going to be able to grow like they have, isolating themselves from the world and not being a global player. It's going to be very, very, very interesting. Not that China's not investable, because it is. They've got some tremendous companies there. But all of a sudden, the US could say, sorry, you can't deal with us. You can't get your semiconductors. And that could be game changing for a lot of companies that rely on that for their technology and to keep up with others. And so it'll be interesting to see how, all that plays out. But we might be okay for a couple of years here still, because the real bad recessions that really crush, earnings, because that's the next phase. It comes when you get the layoffs and everything else. And with the reglobalization and the jobs coming back home, that recession may not be as bad as some of the past cycles. Certainly not like the great financial crisis. And so again, a lot of interesting things at play here in terms of when the bottom is coming. It could be 6 months from now, it could be 12 months, it could be 18 months. Like that, nobody knows with any certainty. But we do know historically, when you measure other recessions, that the bottom usually doesn't come in till the Fed starts to ease. And it's going to be a lot harder for the Fed to start to ease and for governments to spend money, given how the US election is going to go and the general state of debt to GDP at the government levels around the world. So this cycle has a lot of challenges that we haven't seen before. They're all going to rhyme in some way, but it's very, very different, for the next couple of decades as I see it. And I would encourage everybody to do some study in that area. So on to our Q&A, about half an hour left, so we'll get into that. So first question, can I explain how the rise in yields affects the downturn of equities? This week, the rise in yields overshadowed earnings. What does that mean? So 22% as of today's close of the S&P 500, 23% have reported. It's pretty much in line with expectations based on past cycles, where the percentage of companies beating earnings has been, in line. And so far, so from an earnings perspective, we're not going to see, and we really haven't seen companies downgrade. They've all warned that currency headwinds and so forth are a problem that's going to matter. So a lot of these things will start to come into play in the quarters ahead. But how much are earnings going to go down? Because right now, the markets are still saying that fair value calculation that I looked at in my pro eyes for the forward earnings and for the expectation of earnings forward based on where interest rates are, in other words, the equity risk premium, those factors today, may not be there. So I'll get into that in a little bit here. So let's have a look at, what's equity risk premium. So people are asking, why does the cost of money impact? Well, if a company's got to pay more for debt, then they're going to get some margin pressures. And so there's basically this thing called the capital asset pricing model. And when you think about what equity risk premiums are, you think about the capital stack of a company. You're going to invest in Apple. So you can own the equity or you can own the debt. And you look at the debt, and a 5-year Apple bond is yielding X, and the dividend of Apple is Y, and then you've got equity risk in owning the equity versus the bond. For the most part, you're going to get paid back your money in 5 years on a company like Apple, but not in every company, right? So you look at, if I'm investing in a risk-free investment, now the debt of Apple is not risk-free compared to government. So typically in a capital asset pricing model, and when you're thinking about equity risk premiums, you're looking at what, say, a long-term government bond yield is. You can look at it at a nominal basis. You can look at it on a real basis, meaning after inflation, and then you can do a calculation based on, well, what is the long-term cost of money. So if I made an investment right now in a 10-year treasury, I'm guaranteed to get 4.2% ballpark. Now, if that 10-year rate of inflation is expected to be, right now, the 5-year is trading at under 3, then I've got a 10-year real rate of kind of 1.5%. And so you then compare that to the what you're going to earn on the S&P 500. So this was a study that I pulled off the internet that was from Royal Bank, and was published very recently. And they basically looked at the 10-year real yield. They looked at the earnings forecast for the S&P 500. So in 2022, they expected $215 of earnings in the S&P 500. And so you then take the S&P 500 value, you take the earnings, and you get a PE, a forecasted PE. And then to get the sort of the earnings yield from the market, you invert that. So you take, very simply, a PE of 20 would be a yield of 5%, 1 over 25%. So you can kind of see how that works. So if your forecasted PE is 14.1, then your equity risk premium is 7.1. And then you compare that to where the nominal yield is, or the real yield. There's different models for doing this, and that comes up with a forecasted value, a fair value, not where the year will end, but a fair value forecast based on earnings and interest rates. And that's kind of, to answer your question, the relationship with so as bond yields go up and your guaranteed income rises, you need more of a risk premium in equities, because equities are going to do this. There's no guarantee of return. And so you're going to have a lot of volatility along the way. The guaranteed return in equities is your dividend, right? That's your yield. So they look at the earnings yield, but companies don't pay out 100% of earnings. They only pay out a fraction of earnings. Part of those earnings are retained, and then therefore you theoretically get some growth in the company as they reinvest that by buying back shares or by expanding their businesses, right? And therefore you get growth in their earnings. And so as an equity owner, you participate in the earnings of the company, where you don't in terms of of the debt. And so if you then forecast what earnings are going to be out as far as you want to go, you can do that. And then you could say, well, what are interest rates going to be? And you make that forecast. And then you can come up with a target and an estimated average return. So there's advantages and disadvantages. It's a great framework. It's easy to use. The disadvantages is the subjectivity of your forecast, right? How good are you at forecasting earnings and interest rates? Well, the answer is nobody's any good at anything. Just look at the smartest people running the Federal Reserve and what their forecasts were a year ago about inflation. So nobody can do this with precision. And so all these models are just guesses, right? So who do you trust guessing what it's worth? but we have these frameworks, and I'm not sure if you can see it, but when you look at the relationship historically of the monthly risk premium and yield, and you run a linear regression through it, you can create a formula for forecasting. So you plug in, what your number is, and that gives you a forecast for what your outcome is, or i.e. the market in this case. And so it's a very interesting way to look at it. It's a great framework, but there's a lot of volatility in the forecasting, and that's the problem with it in that regard. Can I explain the results of the recent inflation report? I assume you're talking about Canada, because you ask in the second part of the question, what do you expect the Bank of Canada to do in response? So this week, inflation numbers came out. They were a little higher than expected, not unlike what we've seen in the US recently, and Germany, other places in the world. So there's a framework for evaluating what's priced in and what isn't, based on what's priced into the short-term interest rate markets. Investors and money market participants, they're not stupid. They understand there's a meeting next week, and I don't want to pay yesterday's price. I want to pay tomorrow's price based on what I think they're going to do with interest rates. So you have what's called an implied interest rate in the overnight markets, in the funding markets. So based on where the target rate is today at Bank of Canada at 3.25, right now, or as of this snapshot that I produced on Thursday at some point, or maybe even it was Wednesday night, I can't remember this slide, maybe it was Wednesday night, that at that point in time, based on what's priced in, 2.982 rate hikes. So basically 74.5 basis points of 75 basis points. So the Bank of Canada next week, based on everything that everybody knows about everything, is fully priced for 75 basis points, like that much less than that. I'd have to look at the latest numbers. But so that's what you can expect from the Bank of Canada next week. And then for their meeting after that on December 7th, another rate hike. So you got 100% chance of them going up a total of 1%. So 75 in October, another 25 in December, and through then the first quarter, there's not another full rate hike priced in. So if there was 5 25 basis point rate hikes priced in, you would see this number of hikes at like 475, right? So the implied rate hike would be 1.25. So right now, the implied terminal rate in Canada is 4.4, that you can see there right in around the March, April meetings, and then it starts to go down from there. So what this is saying is that it's taken the guidance of what the Bank of Canada said, it's looked at all the economic reports, it considers what the US guys are doing, other places in the world, but mainly the US, and it's basically pricing accordingly. So that terminal implied rate is very similar to what the Fed dot plot is saying. So again, pretty similar interest rates between Canada and the US is what's kind of likely, already priced into the market. So I hope that answers your question. Why have food prices continued to increase rapidly while inflation has slowed? Should they not rise or fall in parallel? And the simple answer is no, but maybe. So here's an interesting chart that shows the components of CPI. So the dark white line is the total amount of CPI, and as the last US report that came out on October 13th, 8.3% was the number. The core inflation that excludes parts of food and energy, 6.3, and then it's broken down by services, commodities, ex food and energy, call it lumber, metal prices, aluminum, textiles, and on and on and on, and your raw materials for creating stuff. And then it's got food, and this is kind of food as in raw food commodities, wheat, meat, etc. And then you have energy, and that energy is crude oil, it's unleaded gas, it's heating oil, it's natural gas, it's everything to do with powering, the world. And so here are the components. And so what you can see here is that the services side, excluding energy input, is rising the fastest. That is tied in with service cost and labor in a pretty significant way. There's not a lot of labor. When you look at a farm and you look at the cost of producing a bushel of wheat, labor is around 10% of your cost. Fertilizer is around 30% of your cost, just by way. So fertilizer prices are going up, which they have been, certainly since Russia and Ukraine produce a lot of fertilizer. That's going to have a direct impact. So again, the question is, commodity prices have come down. Yes, lumber, so those commodities, ex food and energy, has come down, and you can see that compared to a few months ago, where in March and February, that 1.5 today looked like it was closer to 2.5. However, the services number back then that was 2.5 is now 3.5. So overall, the same. When you look at, the energy input, energy's basically been flat for a number of months now. Oil prices have peaked, but gas prices have come down, but natural gas prices have gone up, and so forth. But generally, energy is kind of flatlined a bit, but really has been increasing, of course, since the negative impact that we saw, in say the year around COVID, and we had seen negative oil prices and things like that for a very brief inflection point in April of 2020. So those are the components of inflation, and I hope you can now see why inflation at the headline can come down, but food prices can actually keep going up. And so when you look at food in Canada, grapes don't really grow much in Canada, and the ones that do, for the most part, are used for wine. And so when in the winter we need grapes, and those grapes are being frozen for ice wine, we need to get those grapes from somewhere else. And if the Canadian dollar is weaker, import prices go up. So Canada produces all the wheat it needs. Canada produces, in theory, all the energy it needs, although God knows why we import energy from Saudi Arabia. Story for another day. But you get the idea. So not everything that we eat, we produce enough of. And part of the deglobalization is the thought where, countries want to be more self-sufficient. They want to be more reliable internally. So does that mean we create greenhouses here and grow tomatoes in the winter versus importing them from foreign? Is that going to raise the cost? Absolutely. So there's a lot of thought behind less globalization, producing something globally, which has basically been the case where Trump and others, but said, you lost the job to China, we're going to bring the job back. Bring the job back, no problem. It's just going to cost you more. And so we're going through a period of higher inflation, and you're seeing that in this graphic here. And again, you can go back and look at these things for a lot of periods and kind of see the makeup. But that's a great question. It's part of kind of what I talked about there. Can I explain how uranium fits into a green future? Nuclear energy is perceived as dangerous. I don't believe uranium is part of the BMO clean energy. That wasn't in the hierarchy there. that Vish had talked about. But uranium, not in my backyard. I don't want it here. But so Germany was shutting down all their uranium. This is the great example. France produces 75% of their energy through nuclear. They've never had any big issues with it culturally. They never shut anything down after Fukushima. But Germany we're decommissioning everything. Germany now burns more coal because of what's happened in Russia and Ukraine and not getting enough gas for this winter than they ever have in the history. And so when you think of how do you produce large scale energy, clean and efficient, nuclear, it's a no friggin' brainer that needs to be there. Politically, there are challenges of implementation because of X, Y, and Z, and those things are obvious. And it's, as you point out in your question, it's that negative perception. Japan is turning on nuclear again. Japan has nothing. They've got a limited offshore gas capacity. They've got to import everything they do. They're not set up well. They're set up well for wind. They're not set up well for solar. Japan is screwed. They've got to import all their energy needs. They got to go back to nuclear. They got to do it smart. And how is China going to get off coal? How about India? And so if the world is going to go to net zero, uranium has to be, and nuclear has to be, part of the solution, because we're not going to be able to do it through wind and solar at scale for decades, according to the graphics that we saw tonight. So that's a great question. Really like your YouTube channel and all the content. Well, thank you for that. Do you have a team working for you? Yeah, obviously I don't produce it all myself. You may have seen on an email that this Investor's Guide to Thriving is produced by a firm called Prosper Experiential Media. It's a company that I'm involved with. I own part of it, to be fully disclosed. But it's a company that does social media and web content for not just my company, but for lots of financial companies out there and others. So it's really a very, very efficient thing. So they kind of do that. And so more content coming to YouTube. We're going to modify the way we do these webinars. Creating new content every week, folks, it's not easy to do. So we're going to do more through YouTube. We're going to do, more ad hoc things. I am going to do podcasts. I mean, show of hands, who would like me to do a podcast with, a Federal Reserve governor? If I can get someone from the Bank of Canada, if I can get a major portfolio manager, Jim Cramer, who would want that? We can talk about those inverse ETFs they just launched off his recommendations. I'm just kidding. Someone like Kathy Wood at ARK ETFs, that would be great to do some. So we've had guests on in this format over the years, Rosenberg and some other people that I like and follow. So, more of that's coming. And that really is all supported by my partners and friends at Prosper. So great question there. Bank stocks taken a major hit since February. Would bank stocks not be relatively safe bet in time of inflation? Why am I so far down? Well, because you didn't listen to me a year ago. No, I'm just kidding. Bank stocks are fantastic. This is a chart of the Canadian ST Banks Index going back into, I think it's mid-1980s there, as you can see in the chart. And you can see with the 3 or 4 US recessions highlighted, not Canadian recessions, but Canada had them 2 different magnitudes and so forth. What happens to bank stocks generally during a recession? So the answer is everything goes down. Bank stocks may go down more or less depending, so when there were more credit concerns, like the great financial crisis, where there was a lot of credit risk embedded in housing and real estate, that Canada didn't take a big hit, but the US did, we go down in sympathy, right? So, that COVID shut down the world, banking future, okay, big hit. So did the banks get artificially inflated because of safety, great dividend? Was it a bit of a bubble? Is it normalizing now? I would argue that's where we are, and that the price a year ago was a little artificially high. And so maybe semantics, but banks start to get interesting to me when I look at the ranges of the last few years. Could be another 10% downside, but they're starting to come onto my radar again. I haven't liked them for a while here, and I haven't put a big investment in them, but I'm starting to look, very closely to when I have a feeling or a belief that, all the bad news that would be related to the banks are priced in, and that when we start to get a steepening yield curve, banks are going to really benefit. They have benefited to a great extent by rising yields. They're able so far to hold their net interest margins, but going into a recession, there's going to be credit losses. And that's what really comes into the cycle at this point, and why banks aren't doing well. End of that business cycle. Joe Biden is releasing 15 million barrels from the oil reserve. What will this ultimately do for gas prices at the pump? And, interestingly enough, 6 months ago, Biden said, we're going to release 1 million barrels a day for 180 days, 180 million barrels. And oddly enough, that was right until about now, before the US election. So he had a political motivation to take the Strategic Petroleum Reserve for political gain. Make no friggin' mistake that was a core part of the decision making. Now, did it help? Absolutely. Prices at the pump have gone down. Let's have a look at a chart here. So this is the Department of Energy going back to the early 1980s, and the level of oil in the Strategic Petroleum Reserve inventory. And you can see that over the last number of months, there's your 180 million barrels, right? We've gone from about 600 million barrels to a little over 400 million barrels, 405 as of the last reading last week. That'll get updated again next week. And so he's released 15 more million barrels. Is it going to matter? Not at all. But the hopes are, in the last 2 weeks of the election, by releasing another million barrels a day, that is going to make that marginal voter that is independent, that when they went to the voting poll that day and filled up their car, that it was a little bit less than the week before, and maybe that marginal vote goes to Joe Biden. I think that's kind of what it means. But what this ultimately means, the Strategic Petroleum Reserve can hold about 700 million barrels. And if we're going to go into this world where US wants energy independence, they're going to have to refill this Strategic Petroleum Reserve. They have a policy out there on when they're going to do it. If they're smart, in the next recession, when oil prices come down, they buy it. So there's probably a natural floor that's going to reverse this demand for oil, that's going to add probably 200 to 300 million barrels of oil over the next 2 to 3 years. And so a lot of the oil bulls are pointing to that. The next chart here basically shows us that the US oil demand, so on the left side, we have the oil demand side, and currently, and for the last number of years, around 18 million barrels a day is what the US consumes, okay? So you think about what 1 million barrels means a day, for the last 6 months, and say continuing for another couple of weeks. And what did that do? It really didn't move the needle at all in terms of the demand level of oil. It obviously helped with supply and kept prices down a little bit for what obviously would have been more of a supply side shock coming from this Russian war and rebalancing, around the world. What I want to point out here is if we go back and look at a number of years ago, the US was up to 19 and a half million barrels a day. So we actually have seen about 5-6 years ago the peak in oil demand. Again, going back to what Vish had talked about today, was that the demand for gas for cars, not for trucks, not for airplanes, but for cars, has peaked because of the EV movement. And so demand for unleaded gas has peaked. Overall demand has peaked because of that. But, in order for us to get back to, this number needs to come down to 16, 15, 14. I see the average demand for oil going back, 30 years. So that will come with efficiencies, with technology benefits, with, less reliance on the barrel of crude oil. And that just is measured in decades, not, years for sure, but decades, not days or weeks or months. And so the do it now crowd of the Biden administration, they're out to lunch in terms of their expectations, in terms of a reality check. I get there's some urgency here, but again, net zero is measured in decades, not weeks, months, or years. When you look at the stockpiles and the supply side issues, stockpiles are way, way, way low now compared to 5-year average, and this is something that people look at. Part of this is the SPR, but overall stockpiles are low, and so there's going to be a rebalancing in demand. So there's underlying support for crude oil prices at lower levels here, maybe for the next 2 or 3 years. So that'll be very interesting. And so final question tonight about the election. We're almost out of time here. So what's happening in the polls? Blue, red wave. Again, what 538 is saying, and by no means is this truth. This is expectations based on polling that, Senate still tilts blue. So we get a divided Congress. That generally is the best environment overall for government spending less, and for less government and more business. So that would be deemed as a positive outcome, for the markets. And yeah, folks, we're out of time tonight. So just I had a couple more questions here that unfortunately I'll do them next week. But thank you for attending. Again, please consider visiting the website of one of our partners and sponsors, and please make a donation to one of our charities if you've enjoyed these things, if you're learning, and if you want to thank us. Have a great week, everyone.